Live from the Business RadioX studios in Atlanta, it's time for the Exit Exchange, brought to you by XPX Atlanta, dedicated to changing the trajectory of exit planning services in the Southeast. Now, here's your host.
And hello again, everyone. I'm John Ray with Business RadioX, and also here on the Exit Exchange, hosting the show along with Maria Forbes and Bob Tanksley. Maria, Bob, welcome.
Good morning.
Hey, John. Thanks for doing this again.
Hey, absolutely. Great to see both of you again and have you back on the show. And we've got two great guests I want to get to in just a second, but I want to remind everyone, our listeners certainly, that this show is brought to you by the Exit Planning Exchange Atlanta chapter. This chapter is located right in the center of the Southeast, and because of that is ideally positioned to serve an extremely high concentration of family and privately held businesses. The board membership and sponsors are comprised of a high-quality network of advisors and services providers that are focused upon collaboration and placing the client's interest at the center of everything they do. If you'd like to know more, go to xpxatlanta.org. And now I want to welcome two great guests, two friends of the Exit Planning Exchange, Eric Togneri with Neri Capital Partners, easy for me to say, and Robert Margeton, or Rob, better known, and he is with Ryco Advisors. Eric, Rob, welcome.
Thank you for having us.
Thank you.
Absolutely. Eric, let's start with you. Why don't you give everyone an introduction to how you're serving folks at Neri Capital Partners?
Sure. Neri Capital Partners is a boutique investment banking firm. We really have three tenets to our service offering, our unique value proposition, and those are determining, building, and realizing the value that's been created by privately held business owners. And just to elaborate really quick on each of those three areas, determining is the term that we use for describing business valuation. Building is sort of a longer term proposition, a consulting arrangement with business owners to help them improve the value of their companies. And then realizing is an actual exit event. And so those are the three services that we have at Neri Capital Partners. We are a father-son founded firm. We have 8 folks strong, including my dad and I, and we've been in business now going on our 17th year.
Terrific, Eric. Thank you so much. Rob, tell us a little bit about you and Ryco Advisors.
Sure, thank you. So before we founded Ryco Advisors, it's my wife and I were business partners. We worked in finance in New York. She did investment banking and private equity, and I worked in middle market restructuring. So I worked on very large distressed companies. We moved to Atlanta. We purchased an existing business. Over 4 years, we doubled the size of that business and had a really good exit. And then we formed Ryco Advisors to fill the need. There's a lot of owner-operated businesses that are, call it 5 to 50 million in revenue. And business owners don't know how to market value and sell those businesses. So we formed Ryco to help with that need. We only do a few transactions a year and try and maximize value for our clients.
Hey, good deal, guys. Rob, Eric, thanks for your time this morning, and thanks for all that you do for XPX Atlanta, our chapter here. As we often like to do on these shows, we like to start with kind of a high level, big picture, drill down a little further, and then drill down into some more details. So sticking with that format, what are you guys seeing in the world of M&A, particularly here in the lower mid-market? I know we've kind of flushed out the COVID backlog, so to speak, all those deals that were pent up, maybe got delayed. or maybe died during COVID and then got resurrected in the months that followed. So we're kind of past all that, but where are we now here toward the middle of 2022?
Well, to give it some perspective, I mean, I go back to our founding year, and I came out of corporate America and got into this business really as a completely transactional firm. So we did little in the way of business valuation and little in the way of value building back in those days, but we were doing a whole lot of transactions. And then the recession hit in 2008, and it really weeded out our industry. There weren't a lot of folks that were able to weather the length of that particular downturn. But what it did for us, it really resulted in rethinking the company, rethinking the utility that we offered to business owners. And because we found out really quick, that business owners really had no use for us if they weren't selling their business the way we were structured back then. And so we came out on the other side of it, and really since I'd call it mid-year 2010 to present, it's been a steady climb upward with the exception of the COVID. I call it a pause because we really didn't lose any deals during that time. They just got put on hold for about 6 months. But every year seems to get a little bit stronger in the business, and I think it's really driven by a number of things. Everybody has talked about for years the dry powder that's out there. I mean, lots of cash to buy these businesses is available, and so there's that dynamic. But there's also, I call it the experience on procrastination has come for the baby boomer business owners. Whereas in 2008, if they were thinking about selling, they could put it off. They're now in their 70s, and they don't really have much of a choice any longer. If indeed their choice is to have to sell to a third party, they've got to make that move. So it's been extremely robust. Our firm has been able to ride this wave very successfully, and it's an exciting industry to be in when there's consistent year in and year out growth. But I think really the main thing, as I look historically back at our company, that 2008 to 2010 period was just critical because it caused us to redefine the organization.
You mentioned boomers, and I've heard it said that boomers own collectively about 3 out of 4 businesses in the lower mid-market. Just a startling statistic. And they've got to get out, right? If they've got something to transfer, they got to get out eventually to transfer that value. And what we've heard COVID did was really accelerate timeframes. Rob, what are you seeing from your vantage point?
Similar to what Eric said, I would say that certain businesses were impacted through COVID, hurt their financials. People are getting their run rates back and even growing at this point. And those business owners who are boomers or an owner-operated first, second generation business where the owner's in his 50s or late 60s, now that their financials have stabilized, they're like, I want to exit. I don't want to go through this again. There's a huge amount of dry powder, as Eric had mentioned as well. All these private equity groups are going down market and they're chasing valuations higher, and it's a seller's market. So we're having a lot more conversations, a lot more exploratory calls than we even had the prior year. And there's a lot of high quality businesses out there.
How often are you guys picking up a new client? You start talking with them, and it turns out they're getting unsolicited offers from PE, from competitors, maybe even publicly traded companies. How is that conversation happening with more frequency these days?
Absolutely. We're selling a foam fabricator right now that does about 10 million in revenue, and every other day I'm getting emails forwarded from my client saying, hey, someone's reaching out again. It happens constantly. So there's a lot of solicitation to find proprietary deals, because all these lower middle market private equity groups are trying to consolidate every industry you can imagine, and they're chasing buyers or sellers and trying to go direct to them.
So we're sourcing heavily and relying on our business valuation service. It's a very important part of our go-to-market strategy as a company, and it's our pipeline. So what ends up happening with business valuation work is we're up to we'll do over 100 business valuations during this calendar year. About 80% of those valuations go into sort of that value building queue. They're not quite ready to go. But the remaining, about 5% of slippage, but about 15% of that goes straight into a deal that that we're working actively to help facilitate an exit. And so I think that's just been a really big part of our deal flow and our focus.
Yeah, I've heard it said, 98% or so of business owners don't have a solid understanding of their true business value. It re-shocks me every time I say that.
Yeah, I think the SBA put that statistic out there, and it is astounding. And very many of them believe they have a perception of what their business is worth, but when pressed, they've never had a formal business valuation. Maybe and this was more for the cash that they had on hand in their cash flow, but maybe a line of credit gave them some sense, but they truly don't know. And so we get quite a few that, believe it or not, are pleasantly surprised. They didn't know that they had created something that valuable, but more often than not, their perceived value is higher than their actual market value.
Still kind of sticking with that big picture theme. Here we are, as I said, kind of in the middle of 2022. I'm not talking to any business owners without the following topics coming up still again and again: labor issues, inflation, supply chain. What are you guys hearing from clients, potential clients in those areas as well?
I mean, they continue to be real issues. Supply chain for certain businesses, prices are going up, and those businesses need to figure out, can I keep putting price increases through to cover my labor as well as the higher cost of product? And by the way, when is it coming in? So these still remain day-to-day issues for owner operators. And in the near term, that's not changing.
Yeah, the pressure is on basically for pricing their products. And we're seeing a lot of folks, especially in the trades, go into cost plus quoting. They've got to figure out a way to keep their margins, at prior levels. So inflation in particular has been an issue when it comes to that piece of it. And then the supply chain, it just really varies by the business. I mean, I had a very specialized HVAC company I sold this past year, and they were heavily reliant on circuitry from Asian sources, and the resulting supply chain was just really causing lots of projects that were on hold, just waiting for materials.
Yeah, very good. Hey, Maria, did you have a question for Rob and Eric?
Oh, so many questions.
I figured. Fire away.
Rob, you said something. It's very relatable, and I'm always trying to pick up on how we can make this very understandable content. And you said we start with fleshing out the ugly. And Eric talked about value building Q. What happens, when owners, because owners don't know what they don't know about the value of their business. Tell us about the diligence process and how you get to those risk factors that owners are really so unfamiliar with before they talk to you?
Sure. So before we take on any engagement, we usually set up a quick exploratory call, and we talk, and I try and flush out, all the value drivers or lack thereof. And then if they're seriously interested in running a process, we spend several weeks doing our own financial diligence and operational diligence on those companies, because that's what buyers will do. We're working on something right now that is a few $1 million deal, but a private equity group came down market for it. Well, they're ordering a quality of earnings report. They have 3 different outside third parties doing diligence on this few $1 million deal. I've added 15 different professionals to the data room to pull information. That would be very, very overwhelming to manage for an owner operator trying to go down the path alone. So it helps to have an advisor who knows the process and can figure out anything that a buyer is going to figure out ahead of time and try and mitigate.
Yeah, Eric, what do you talk about in the value building queue once you realize that owners' businesses are not ready for market?
Yeah, so some of it goes outside to third parties. Some of it we do internally. The valuation work that I described earlier naturally leads into a discussion about why the company is valued that way. We happen to use a software product that allows a comparison to the competitive set for their industry. So they're able to look at whether they're underperforming on par with or overperforming the market sector across a number of different variables, financial variables. And then from there, I think just a big part of it is having really robust discovery up front. If they're ready to go to market, it becomes very easy in the sense that we have to create certain documents, namely the confidential information memorandum, which is basically just an extremely thorough overview of the business opportunity. And that naturally leads to figuring out what's there. I think, one of the key things is just being, this isn't the time to puff up people's egos. It's not the time to insult them either, but it is a time to have a very frank discussion about the state of their company, how they can improve their company. A big part of our process, and this keeps our queue warm in terms of deal flow, is, we go back and, see if they actually worked on the things that we've talked with them about. And that would be reflected in the updated business valuation that we perform on their behalf.
Yeah, let's talk about, specifically some of the things that come out of the due diligence process. What are some of the common sort of deficits, if you will, that owners suddenly have to recognize and wrestle with?
So one thing that is customer concentration. So as a percentage of your sales, if one customer is, 30, 40, 50% of your overall business, that's a huge perceived risk for buyers. Some won't even look at it. Some might try and do a seller note or an earnout, so you're not going to get all cash at close. So if a business owner is 2-3 years away from selling, they can work on growing their sales pipeline with other customers to reduce that customer concentration. Another value driver is the owner running around silly, micromanaging, working 60, 80 hours a week. To sell a business for a higher value, that owner has to start working themselves out of a job and maybe hire an additional person, because a new owner needs to figure out, what am I signing up for? How much do I need to work in the business versus grow the business? So there's a lot of different things that we look at and we talk to the owners about. And if they have, a significant amount of time, they can change those things. The last thing I'll say is, for owner operated businesses, sometimes they use the same CPA for 20, 30 years. They might be doing some shenanigans with their financial accounting, and if they have enough time, they can clean that up. Because if a buyer does a quality of earnings report, they're going to beat them up really bad.
Yeah. And Eric, what are some of the primary risk factors you run into?
Yeah, I think that comment on the owners is all too common. They tend to micromanage and work just extraordinary hours. And when I get in there, I'm like, hey, you need to start managing yourself to a 20 to 40 hour work week. And just use that as a goal, which is usually completely foreign to these people. They have no idea how to even do that. So that is cause for some pretty robust discussion, and it's worth saying. Now the books, when we used to do really small businesses, we had a lot more of an issue with people's personal expenses being tied up in their business. Not that I don't ever see that now, but it's usually a relatively small amount with these businesses that are sort of in our sweet spot is sort of $5 to $20 million valuations. And so we don't run into that as much. What we do run into though is a competence level. They typically have a decent outside CPA that's going to be doing tax work for them, and typically have some sort of bookkeeping controller function internally. But almost invariably, it's like the wife of the business owner, it's the cousin, it's someone, from their church. We get these people that not that they're necessarily, terrible, but probably not, hired in a way that would make their books as acceptable as possible. I mean, these folks are not practicing GAAP accounting, and so you really need a competent, bookkeeper that's just going to stay on top of it, because that's the level of scrutiny it's going to be given when somebody comes in.
Yeah, and that really speaks to, I think, the key leadership roles in a company. When you are in that due diligence process and realizing, is there solid leadership? Are there people? Is there good talent and experience surrounding that owner or partners, so that they can begin to work themselves out of a role?
Yeah, I mean, business owners, they're typically really good salespeople. You know? And how do they let go of the sales function, and not have it completely relying on their relationships or their abilities? And so, so you typically say, hey, you not only want to hire for the issues that you have. So say they had they needed some operational improvements. Well, that might not be the forte of the business owner, but the really successful business owners are good at hiring people that do something that they already do very well themselves, but they have to hire somebody else to come in and take that burden off.
Yeah. And in true XPX style, we always want to understand for our listeners, when other advisors will know they need you. We can make a lot of assumptions around, is an owner ready to sell? Are they, feeling burned out? Do we, what process do we start first? What would you just say, this is how you need us? What are some of those symptoms or conditions?
So I would just say that, a lot of times we'll get referrals from attorneys or wealth advisors, and their client is thinking about selling, doesn't know anything about the process, and just wants to get educated. And we're happy to have those exploratory calls. If it's not a great fit, it's not a great fit, or, they're not quite ready. But we always like to educate and help those owners. They're, highly successful. They just don't know this world and kind of the language we speak and how institutional or sophisticated buyers view the business world. So whenever they start thinking about it, we're happy to talk to them, even if it's a few years out, and just keep them in the pipeline and kind of talk to them every 6 months or so and follow up.
I think knowing that is important. That it isn't a transaction that occurs, but there is a relationship inside of that says, we're going to touch base with you. We're going to help you and be an advocate, if you will. And in a way, you talked, Rob, about the larger the business, the more sophisticated buyers will take advantage, of owners, and they need somebody on their side. And I think that's the understanding the role you play is important in realizing how we can collaborate.
Absolutely. It's all about collaboration. And we also have a deep bench of different referrals in our network to bring to the table to help get it closed. So if a buyer's like, hey, you need an indemnity escrow of 10% of the purchase price and it's 10 million, a seller's not going to want to keep $1 million in escrow for a year. Mm-hmm. Well, there's a product called rep and warranty insurance where they can spend $15,000 and not have that escrow, but they don't know what they don't know. And we could bring those professionals to the table and educate them and say, this might be a different path.
Yeah. So Eric, talk about the relationship when a business isn't ready to sell. You do so many valuations in a given year. What's the relationship like for you when a business, the valuation isn't satisfactory? And kind of explain your conversation. You talk about being direct and honest and making some recommendations that would help that owner while they to get ready for market.
Yeah, so these it's hard to generalize about these conversations because they are so specific to each individual situation. But just generally speaking, it usually goes down a route where they're missing either an outside advisor or internal human resource that they need. And so that's usually, the first piece of it. And then the other piece is just the getting the financial house in order. And that's hit or miss. Some businesses, the books are pristine, right? And some of them need a lot of help. And so just talking with them about what that looks like and, getting the right resources in place for them. To go back to the prior question on how we work with advisors, I mean, almost 90% of our deal sourcing comes from other advisors. It's usually other advisors are past clients. That's where we seem to get the vast majority, and very little B2B. Marketing, advertising. We're going to look to change that in upcoming years, but right now we're heavily relying on advisors, and almost always it is a conversation where an advisor's client begins to talk about the potential of selling the company, and then we just do a lot of educating advisors on that valuation piece so they can give us a solid introduction.
Yeah. And that introduction, in terms of timing it with business owners who say, I'm burned out, I'm ready, I want to make a change. You talk about 2 to 3 years out, pretty much, I think. Is that about the same for both of you?
Sometimes business owners are ready, and we'll do our diligence and we'll come up with an opinion of value. And if it's within their expectations, we could go to market pretty quick. That has certainly happened a lot this past couple of years. But we also will court people 2 to 3 years out. Like we're hopefully getting engaged on a larger business in the next couple of weeks, and we've been talking to them for the past 2 years. So yeah. It all is deal specific.
Yeah, we find, in other professions serving this same market that, we're hearing sort of, we're hearing red flags for a number of years. At times, with owners are saying, I'm really feeling tired. I'm feeling burned out. I'm, feeling different things. And, we're all managing that emotion from our various, areas of expertise. And sometimes, it's just them changing their role for a bit, and that helps them kind of shore up how they're spending their time and energy. Other times it's really, they've hit the wall, they're ready. But we have to have the intelligent conversation around, is your business ready? You may be ready, but your business may or may not be ready. So I think, that collaboration is knowing when to collaborate, knowing when to bring you in, when to have the first conversation around readiness is important for our listeners to realize.
Yeah, what to keep in mind is that if they're ready to go, M&A from engagement to closing is typically minimum of 6 months and oftentimes 9 to 12. And so it's not once the decision is made, it's not like you just flip a switch and sell the business. The other thing to keep in mind, though, is if there are issues that need to be addressed in a company, that's where you get that 2 to 3 year time frame, because in order to make a meaningful change in a company, it takes a substantial amount of time, focus, and effort. And usually you count that in years, not months.
Yeah.
I call that reducing buyer objections before any buyer has a chance to raise them. That's an optimal company, an optimized company to take to market. We know we're going to get beaten up, and in the world that you guys play in, for every sell side client that you take on, you're probably talking with, 15, 20, maybe even 30 or 40 even buyers. And so you really are in tune with what buyers have to say about businesses. Some of that stuff is universal, some of it's industry specific, but I've often heard it said that a well-optimized company that's always ready to sell is a whole lot more fun to sell than one that needs some work. But I understand that you guys have to meet business owners where they are if they're ready right now. And here at XPX, we push heavily, and we try to have folks understand the importance of collaboration so that we can gain that 2 to 3 year window of time and make those changes that optimize the company.
Yeah.
Yeah. And I'm probably getting into a different topic here, but, Eric and I, we both like to do a lot of due diligence on our prospective seller. So that way, when we do create marketing materials, an investor presentation called a SIM, and we proactively find the right buyers for that business, we can really get generally speaking, in this current market, we can get more than the seller is expecting to receive. So it's well worth talking to a good advisor.
Yeah. And, we've learned so much in this conversation. I think, we have a better idea of sort of internally the M&A processes and how you collaborate with other advisors. And I think one thing that I'll just mention in closing is that you're familiar with both sides, the buy side and the sell side, right? So you understand what buyers are looking for, and you understand how to help the seller understand that, right? Know what those areas are that buyers are looking at, and what's going to attract the right buyer. So that advocacy, that relationship that you have with the seller is very important to bring both perspectives to the table. I think that's very helpful for all of our listeners too. Is everything you shared with us has been great today. Thank you both so much for giving us a great education and insight on the M&A processes.
Yeah, Maria,
Thank you for having us.
Yeah, Maria, I couldn't agree more. Eric, Rob, you've given us a lot of great information, and I can't imagine that folks that there aren't some folks listening that don't want to be in touch. So let's give them directions on how they can be in touch with each of you respectively. Eric, you go ahead.
Sure. NeriCap.com is our URL, and so they can always go there. All the contact information, not only for myself, but for all the members on the team, can be found in the About Us section. If for whatever reason somebody's just writing down, feel free to email or call me at T as in Tom, OGNERI at NeriCap.com. That's ETOGNERI at NeriCap.com. And you can always get me on the phone at 678-764-1732.
Rob?
Great. And we're Ryco Advisors, RYCO Advisors, ADVISORS. And you can email me at Rob, ROB, at Ryco Advisors, RYCO ADVISORS.com, or call me 678-653-3234.
Eric Togneri, Neri Capital Partners, Rob Margeton with Ryco Advisors. Gentlemen, thanks so much for coming on the show.
Thank you.
Thank you.
Hey, folks, just another reminder, this show is brought to you by XPX Atlanta. XPX Atlanta is fundamentally changing the trajectory of exit planning services in the southeastern United States, and the values of the organization, including putting the client first, working collaboratively, thinking long-term, considering the human angle, and always be learning, are really the key to the success of the organization. So if that's the kind of group that you would like to be associated with, whether you're an advisor or whether you're a company thinking about selling down the road, go to xpxatlanta.org to find out more information. If you'd like past episodes of this show series, you can go to xpxatlantaradio.com or find the show on your favorite podcast app. Maria, Bob, this has been a great one.
Thank you so much, John. It has. Very interesting conversation.
Absolutely.
Yeah, really enjoyed it. Our guests knocked it out of the park this time.
They sure did. And as did our hosts, Maria and Bob. Thanks for the great questions. Folks, I'm John Ray. Join us next time here on the Exit Exchange.